Hey, welcome everybody to the 40 Finance channel. My name's Jeff Beers. Today I want to talk about some wealth killers that I see being made all the time across the board. You know, we talk a lot about investing, we talk a lot about stocks on this channel, and at the end of the day, it's because we're all marching to the same goal, and that is to build our wealth and make a brighter future for our families and our friends. And I know for me, sometimes you're so focused on the investment part that you can be letting money slip away in other areas without even thinking about it. You'll scrutinize buying or selling a stock, you know, for a couple hours digging through details, and then you can turn around and make some of these wealth-killing mistakes, and you basically have wasted your time for a portion of your investment. So I'm not going to waste everybody's time and talk about spending habits. I think we all know that you have to keep your spending in check. You can't be buying things that you can't afford. You can't finance 700 years down the line. I think if you're a stock market investor, you probably already know those things, right? That you can't buy a $100,000 car on a $20,000 a year salary. You should be good enough with numbers to know those things. But I'm going to talk about some other less obvious wealth killers here that can really set you back. So number one on the list today is growing your income. And as simple as that sounds, it can really get lost in the shuffle, particularly if you are working in a W-2 position or a salary position. I personally think that the minimum amount that you should be growing your income every year is at least 10%. At the end of the day in the corporate world, you're going to get that 1%, 3%, 5% bonus or raise to kind of keep you motivated and looking towards the future. But I think you really need to get to plus 10% or more if you really want to make up for the things that come up in life, whether it's general lifestyle creep, inflation, even the expenses of a growing family. So if you don't have a family today or kids or whatnot, but you may have it in the future, just know that all that stuff adds up very quickly, right? Whether it's childcare, clothing, food, all those things not only hit you at different stages in life, but they all get more expensive every year. And if you're not adding 10% or more to your income every single year, then you are slowly going to fall behind. And of course, as you fall behind, you start to lose out on not only wealth opportunities, but the temptation to make poor wealth choices and steal from the future to pay for today. All right, number two on the list has a lot of different variables to it, but I'm just gonna throw it out there, and that is refinancing or moving from your current home. Every time you make these moves or these refinances, there are fees involved, there are expenses involved. And more often than not, you're drawing down from equity you have built into a property. So obviously your first home is probably off that list, but there's also a game in the first home where you are taking, let's just say, a 20% savings amount and you're pouring it into the home. Now for the long term, this pays off, but if you're doing it just to do it, then you're likely missing out on investment returns you could have for that down payment. On the refinance side, we're obviously in a key time period for low interest rates. And as you guys know, I'm a Rocket Mortgage stockholder, also a customer. These guys won't let up on the refinancing game. I'm holding out, and the big reason why is because I am currently at about 3.7% on my interest rate. And while that could go down, I am over 10 years of equity in my home. Frankly, I would rather take the thousands of dollars that it takes to refinance, closing costs, etc., and buy Apple stock, buy Google stock or something like that, and see how the returns would make out over a 10 to 15 year life cycle. It would be interesting. Now, on the flip side of refinance, there is moving to a new home, right? This is where lifestyle creep can really start to screw you. If you're just moving to a similar size or similar bedroom bathroom mix, then you start to put together all the expenses that are involved, not only with physically moving, but for expenses, realtor commissions, all the things that go into moving. You are definitely setting yourself back from an equity standpoint. Obviously, there are cases where you have to move or your family's outgrown their house. Just keep in mind that it should be something that you study long and hard before you go do it. And if you spend, let's just say, $25,000 across the board on closing costs, commissions, all those things, then imagine what that $25,000 could do in the stock market or in your home equity over the next 10, 20, 30 years. It's a pretty big hit to your wealth. All right, number 3 on the list here is retirement withdrawals. And we've seen a lot of this likely during the pandemic where people are down and they need to pay off bills. They have obligations to keep their existing life in order. So they pull from the future to pay for today. And it's a very, very difficult thing because it really does rob you of years that you have to work. And I think the hardest part about doing a retirement account withdrawal in the middle of a hard time like we have today in the pandemic is, in some cases, you are pulling from the bottom of the stock market. So you are in despair, right? Personally, because you have bills to pay. The market is in despair. If you go back to March, April, it's at big time lows. So you need money, your money is worth less, you're pulling it out. That particular scenario, God knows how many, decades that sets you back in that example. But even in a high market, stealing from retirement to pay for today's expenses, not only do you have penalties and fees associated with it, but you have to pay the taxes on it too. So withdrawing $10,000, if you're in the wrong tax bracket plus penalties, you can pay 35% of that right off the bat. And not only do you have to give that money away, so to speak, but now 35% or $3,500, if you're withdrawing 10K, will not grow for the next decade plus. All right, number 4 on the list is being underinsured. And this is really important, and I don't think that a lot of people talk about this, right? So trying to skimp by on your insurance payments, right? So whether you go with a low-cost car insurance provider, or you try to finagle your way down on your homeowner's insurance, you cut life insurance, you lower life insurance. Guys, these are the things that protect you from possibilities that you can't even imagine. And the one thing you don't want to find out the hard way is being underinsured. So if you get into a car accident, or God forbid you hit a pedestrian or a bike rider, these lawsuits can be extremely expensive, and there is a maximum that your insurance policy will pay out. So if you're not sure what your car insurance or your home insurance pays out in the event of liability, you need to double check. There are things called umbrella policies that go above and beyond the standard liability insurance for car and home. And on the life insurance side, if you have a family, you have to have it. There's just no other way around it. You cannot leave your family members with the costs associated with you passing, including your future earnings that they are going to miss out of. So do what you can. Everyone has a different amount of money that they can afford. I understand that. But to be honest, even if you are scraping by, just getting a $25,000 life insurance policy for your partner or your loved one, it makes a lot of sense. And if you're a healthy individual, you will not pay that much money for it. And if you have a traditional family structure where with 2 career workers, etc., then you need to be set up, into the hundreds of thousands of dollars, particularly if you have kids, because you cannot put them in that situation. And even at those high levels, the costs are relatively affordable. I mean, you have to put it in your monthly budget, but the other side of not paying which is things going wrong, can destroy your entire family's wealth in the wrong situation. So please be careful about being underinsured. And the final wealth killer that I'm going to talk about today kind of ladders back in to the first four that we mentioned, and that is not having an adequate savings account. I talked about this on a video, I think last week, where we were talking about small investor mistakes. Not having a savings account is a huge financial mistake. And the number one reason why is because when all the things that we've talked about on this video actually happen, yes, even if you have car insurance, you have to pay a deductible if you get into a wreck, right? So that's $500, $1,000, not to mention upfront medical bills. You could have a home repair. You could have an unexpected bill of some kind for your pet or your children. These are times that come off of the radar, and if you don't have something to pull from, you're going to make the other wealth-killing mistakes, right? You're going to dig into retirement. You're going to refinance your home. You might get a high-interest personal loan, just anything to solve the problem because you didn't have the cash on hand. Quite frankly, I think the lack of a savings account is probably the number one wealth killer, only because it leads you to make mistakes in all the other areas, including stock market mistakes. If you go back to my small investor video, your stocks go down, you don't have savings, problems come up, then you sell. And where do you sell? You sell at the bottom. So these are the things that you have to keep in mind with a savings account. And I get it, as investors, we always see new opportunities come up on the stock market. So if you have that $10,000 saved or $20,000, you're just itching to invest it because you see the opportunity. But the flip side of it is, what if that $20,000, pays for a deductible on your home, right? Or what if you get injured at work and it doesn't pay out, the insurance at work doesn't pay out right away, so you have to pay medical bills up front. You don't want to be in these situations where you're pulling from the future to handle today, because the future money has a lot more potential over the long term. All right, guys, so those are my 5 wealth killers. Hope you enjoyed them. Not trying to be preachy. It's just important to think about this stuff, because if you're making returns in the stock market and you're rocking it, you can overlook some of these simple things and destroy everything that you've built without even necessarily doing anything wrong. All right, hope this helps. Leave me a comment in the descriptions. Let me know what you think about these wealth killers, and we will see you on the next video.